Could cooling U.S. inflation spark an early Fed rate cut? Markets are buzzing after the latest U.S. consumer price data, which showed inflation eased more than expected in May. Core inflation slowed to its lowest annual pace since 2021, with the headline CPI posting just a 0.1% monthly increase. This moderation in price pressures comes as consumers show signs of pulling back and wage growth softens. For markets, this is significant. Lower inflation reduces pressure on the Federal Reserve to keep interest rates elevated. As a result, bond yields fell and equities rallied, with traders now betting on a possible rate cut as soon as September. However, Fed Chair Jerome Powell has emphasized the need for more sustained progress on inflation before adjusting policy. Looking ahead, investors should closely watch upcoming economic data and Fed commentary for hints about when and how quickly policy might shift. Let's move to our second story. ECB delivers first rate cut since 2019, but signals caution ahead. The European Central Bank made headlines by trimming its key interest rate by 25 basis points, breaking a 5-year streak of rising or steady policy rates. The cut reflects slowing inflation in the Eurozone and concern about the region's weakened economic outlook. Notably, ECB officials stressed that this move does not signal the start of an aggressive easing cycle, warning that uncertainty around future inflation remains high. Markets initially cheered the rate cut, but enthusiasm was tempered as policymakers underscored a data-dependent approach for additional moves. What does this mean for investors? While borrowing costs in Europe have eased, the ECB's cautious tone suggests that further rate reductions may be gradual and subject to ongoing economic realities. Investors should pay attention to Eurozone growth indicators and future ECB statements for clues on where rates are heading next. Now, on to our third story. Japan's yen hits new lows despite government intervention talk. The Japanese yen has slid to its weakest level against the US dollar in over 3 decades, trading beyond 160 yen to the dollar. This comes amid a stark divergence in interest rates. Japan has kept its policy rate near zero, while the Fed and other major central banks raised rates sharply over the past 2 years. Japanese officials have voiced concern, hinting at possible interventions to limit the yen's depreciation. But markets remain unconvinced for now. A weaker yen makes imports more expensive and could raise domestic inflation, while also benefiting Japan's exporters. The risk for global markets is that sudden currency interventions or a sharper move in rates could trigger volatility, affecting stocks, bonds, and trade flows. Investors should monitor signals from the Bank of Japan and government officials, as any decisive action could have ripple effects well beyond Japan. Bringing it all together, we're seeing central banks around the world navigate complex trade-offs. The Fed faces pressure to start easing as U.S. inflation cools. The ECB has begun trimming rates but remains cautious, and Japan's currency volatility is testing policymakers' resolve. For investors, staying focused on central bank messaging and key economic data will be crucial in the coming weeks. Drop your thoughts in the comments, and if you enjoyed the video, give it a thumbs up. Don't forget to subscribe and hit the bell icon. Thanks for watching. See you next time. This is not financial advice.